Depreciation, depletion, amortization? Who makes this stuff up? We're here to break it all down today. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence, who, trust me, knows nothing about these things. It's all on me. We're here to put the fun in accounting fundamentals. So when we talk about depreciation and depletion and amortization, they're all similar. They're just applied to different types of assets. So an asset is something that a company owns, it has value, and we're going to use that value in order to create revenue for the company. So as an asset gets used up, it becomes an expense. And we expense the accounting loss of value, not the economic value. So there's a big difference there because the accounting loss of value has no bearing on the actual price that you could get if you sold that asset. So we're talking only about accounting value here. So when we are talking about a fixed asset or a property, plant, and equipment asset, like a vehicle or a building, that's when we're going to use depreciation to acknowledge that reduction of value with that particular asset. If we're talking about a natural resource like a woodlot or a diamond mine or a gravel pit or an oil well, we're going to use what's called depletion. And it works just the same as depreciation. We're just calling it something different because it's for a natural resource. And then amortization, also a similar concept, but we're going to use that for intangible assets like trademarks or patents or copyrights. Those are things that have value for a company. They use them in the creation of revenue, and we're going to acknowledge any loss in value by using amortization. So the concept is the same for each. We're recording the using up of the value of an asset. So when we record the journal entry for depreciation and depletion, we're going to use an expense and a contra asset account called accumulated something. So for depreciation expense, we're going to do a debit to depreciation expense and a credit to accumulated depreciation. For a natural resource, we're going to debit depletion expense and we're going to credit accumulated depletion. Now with amortization, which we use for intangible assets, it's a little different. It's the same concept as depreciation and depletion, but it's handled differently. We don't usually use a contra account like accumulated depreciation or accumulated depletion. We use the actual asset account to record the reduction in value. So always before, when we talked about depreciation, we said, don't touch the asset account itself. We're going to go into this contra account called accumulated whatever. But in the case of amortization on intangible assets, we're generally going to go directly to that asset account. So for example, if we're talking about a patent, then our reduction in value is going to be recorded as a debit to amortization expense patents. And then our credit is going to be directly to our patents asset account. So we're reducing the value of that account on our balance sheet. Still the same concept, but we track it a bit differently. Now the only difference here is the type of asset that's being tracked. Is it a fixed asset? Is it a natural resource? Is it an intangible asset? And that determines the accounts that we use, and it also determines the methods that we'll use to determine the amount that's going to be depreciated or depleted or amortized. So if you need more information about intangible assets, we have a video on intangible assets for you. If you need more information on depreciation, we've got a whole series about depreciation. And if you need more information about depletion, of course, we've got a video for that too. And you'll find all of those linked in the description box. Until next time, stay balanced, my friends.